Figures to watch for in the coming week include those from FTSE 100 firms Sainsbury's, Legal & General and house builder Barclay. But the coming few days are really all going to be about central banks. We've already had the latest policy decision from the European Central Bank on Thursday the 10th. And in the coming week, we'll get the latest interest rate moves and outlook statements from, in order, the Bank of Japan on Tuesday the 15th, the US Federal Reserve on Wednesday the 16th, and finally, our very own Bank of England on Thursday the 17th. Hello, I'm Russ Mould, and in our latest edition of the regular market review Breaking the Mould, I'm going to look at what these three major central banks may say or do. Now, you have two options when it comes to all of this debate over interest rate decisions and monetary policy. First, you can ignore it. You can adopt the line followed by legendary investor Warren Buffett and argue that economics and policy are unforecastable. The Berkshire Hathaway boss suggests you are in fact better off focusing on individual stocks to try and identify those whose competitive position mean they have the pricing power, and that in turn translates into predictable cash flows and dividend growth over the very long term. Or if you don't want the stocks, look for a fund that does the same. Or second, you can pay attention. Interest rate and interest rate expectations are an important part of equity valuations, especially for discounted cash flow, DCF calculations. So you may want to get a feel for rates now, as well as how they may change and how quickly in the future. Now, which of these two approaches, ignore or pay attention, works best for you will be down to your own personal circumstances, investment goals and time horizon. But this trio of central bank meetings could well cause a fuss, because a lot of trigger-happy traders and fund managers around the world will be all over their policy statements like a rash. So, first up, Bank of Japan on Tuesday the 15th, alongside comments from Governor Haruhiko Kuroda. The BOJ has already increased the size of its QE scheme to 80 trillion yen a year, some 500 billion quid, and added longer-dated bonds and equity exchange-traded funds to the assets it can buy. In February, it cut the headline interest rate from 0.1% to 0%, and took a deposit rate for banks down to minus 0.1. Patchy economic data may mean Kuroda-san again takes the plunge, not least to weaken the yen and try and boost exports, as the yen's been remarkably strong against the dollar this year. GDP figures have disappointed, and inflation is nowhere near the BOJ's 2% target, as this chart shows. Then we've got the Fed on Wednesday the 16th, and that's probably the biggie. When Chair Janet Yellen raised rates by a quarter point in December, the Fed's own forecast implied 4 more hikes this year to 1.5%. One of the 8 meetings has been and gone, and this is the second, but the market's increasingly of the opinion the Fed may leave things alone till 2017. Although early March's apparently strong jobs gains and an unemployment rate below 5% means some still see scope for a quarter point increase in June, especially as inflation has ticked up a bit. There's little expectation of a rate rise next week, but check out the statement for any hints of action. No move could be taken as good news for stocks, while hints of a rate rise may cause volatility, judging by May 13's taper tantrum and summer 2015's wobble as examples. Finally, the Bank of England meets on Thursday the 17th. The last meeting saw Governor Mark Carney in the Monetary Policy Committee vote 9-0 to leave rates unchanged at the record low of 0.5%, and QE unchanged at £375 billion. No one expects any action from the BOE next week, and some even think the first UK rate rise will come in 2017, though MPC members Nemat Shafik and Martin Wheel have both been jawboning that rates could rise faster than the markets think, even if inflation is miles below target. That said, we have heard other MPC members cry wolf before, and the latest manufacturing, construction and services sentiment surveys, or PMIs, well, they've all been disappointing too. So a sudden dash to jack up rates does seem unlikely, especially as the UK economy has been decelerating for some time now, as year-on-year GDP growth numbers continue to slow. Given this and the Brexit uncertainty, it's hard to see Mr Carney choosing to rock the boat. But whatever happens, central banks will be strutting and fretting their hour upon the stage next week, and markets will be listening. Whether it all proves to be a tale told by an idiot, full of sound and fury but signifying nothing, remains to be seen. But this is how the major asset classes have done since the Fed raised rates in December. Gold and bonds doing best, stocks bringing up the rear. So let's see whether those trends persist or not, But gold is traditionally an inflation hedge, and it's doing well even as central banks fail to meet their 2% targets. So perhaps the market, via gold, is saying that central banks won't rest until they succeed, even if this means lower interest rates for longer and maybe even more QE. So thank you for watching, and I look forward to seeing you next time.